Financial empires rarely collapse at the moment they appear strongest. They fracture when the systems built to expand power begin to outrun control. The United Kingdom did not lose influence because markets failed or rivals rose faster. It lost control because the architecture it designed to dominate global finance became too complex, too leveraged, and too dependent on perpetual confidence. Stability masked erosion. Success concealed imbalance. What followed was not a sudden fall, but a gradual surrender of monetary authority, strategic flexibility, and systemic command, step by step, cycle by cycle, until leadership existed. In form, not function alone today. For over a century, the United Kingdom represented the most advanced financial system the world had ever seen. Its power did not rely primarily on territory or population, but on structure. London became the clearinghouse of global trade, capital, insurance, and credit. Sterling functioned as the reference currency for contracts, reserves, and settlements far beyond British borders. This system created the appearance of permanence. Financial leadership came to be treated not as a position earned through balance and restraint, but as a natural state. The inversion began when financial dominance shifted from serving the real economy to sustaining the system itself. Capital allocation increasingly favored liquidity, leverage, and global reach over domestic productivity. Financial innovation expanded faster than institutional oversight. Confidence replaced constraint. The mechanisms designed to absorb risk became engines that amplified it. What had once stabilized the empire began to hollow it from within. This inversion was subtle. Trade still flowed, markets still cleared. The currency retained prestige, but the underlying logic had changed. Financial centrality became dependent on continuous, external participation rather than internal resilience. The system required constant affirmation from global actors whose interests were no longer aligned with British stability. Control migrated outward, while responsibility remained inward. The defining error was not miscalculation, but misinterpretation. Stability was assumed to be proof of strength rather than a temporary condition produced by favorable alignment. The United Kingdom continued to operate as if authority over global finance equaled authority within it. In reality, the system had begun to exceed national command. Monetary tools lost precision. Policy choices narrowed. Flexibility eroded. This was not collapse. It was inversion. A system still functioning, but no longer serving the purpose it was built to achieve. The core collapse mechanism of the British financial empire did not originate in a single crisis or policy failure. It emerged from structural overextension layered over time. The system expanded geographically faster than it could be governed, financially faster than it could be stabilized, and institutionally faster than it could be recalibrated. Each expansion phase increased apparent power while quietly reducing margin for error. At the center of this mechanism was leverage. Britain transformed global trade by intermediating credit, insurance, and settlement at an unprecedented scale. These services multiplied influence without requiring direct ownership or force. However, they also bound the system to uninterrupted flows of trust. As obligations accumulated across continents, the financial center became increasingly exposed to disturbances it could not directly manage. Risk was distributed widely, but accountability remained concentrated. Misallocation followed naturally. Capital gravitated toward international finance because returns appeared safer, faster, and more liquid than domestic investment. Industrial capacity mattered less than balance sheet credibility. Time is 0.5s. Over time, this altered the internal structure of the economy. Productive resilience weakened while financial sophistication deepened. The system grew efficient at moving capital, but fragile at generating it. This imbalance did not register as danger because asset values continued to rise and global participation remained strong. Financialization intensified the effect. Instruments designed to hedge uncertainty multiplied layers of dependency instead. Complexity substituted for redundancy. When volatility appeared, it did not dissipate through buffers, but propagated through interconnected exposures. Decision-makers relied increasingly on models calibrated to stability rather than stress. This created a dangerous delay between signal and response. The final element was perceptual lag. Britain's leadership interpreted persistence as proof of control. As long as contracts were honored and settlements cleared, authority was assumed intact. Yet authority had quietly shifted. The system's survival depended on external actors choosing to remain engaged, not on internal capacity to enforce balance. Monetary policy became reactive. Strategic options narrowed. Each adjustment preserved continuity while sacrificing autonomy. This mechanism did not break the system immediately. It locked it into a trajectory, where maintaining order required ever greater accommodation. Power remained visible, but control became conditional. What followed was not failure in motion, but dependence disguised as leadership. The historical blueprint for Britain's loss of financial control can be traced through earlier empires that reached dominance by mastering exchange rather than territory. The Dutch Republic offered the first outline. Amsterdam became the commercial heart of Europe by standardizing credit, shipping insurance, and sovereign debt. Its markets were liquid, trusted, and globally connected. Yet this same openness tied Dutch stability to external trade flows and geopolitical balance beyond its ability to enforce. When military and fiscal pressures rose in the late 17th century, financial sophistication could not compensate for strategic overreach. Control eroded long before prominence disappeared. Britain absorbed this lesson selectively. It adopted the instruments while believing scale would resolve vulnerability. The establishment of permanent government debt, a central banking structure, and a globally respected currency allowed Britain to finance expansion continuously. Unlike earlier empires, Britain did not rely on extraction alone. It relied on intermediation. By the 19th centuries, time, 0.3s, British capital financed railways, ports, and governments across continents. The pound sterling anchored contracts far from British shores. This created a perception that financial centrality itself was a form of sovereignty. The gold standard era reinforced this belief. Britain appeared to govern global finance through rules rather than force. Convertibility imposed discipline, and London's markets enforced it. Yet, this system functioned only while Britain's trade position, reserves, and geopolitical influence aligned. The First World War shattered that alignment. Gold convertibility was suspended, debts exploded, and financial authority fractured. Britain attempted restoration in the interwar period, but the system had changed. Capital mobility now exceeded political coordination. The blueprint had reached its stress point. What followed revealed the pattern clearly. Attempts to reclaim financial leadership required austerity at home and accommodation abroad. Maintaining the appearance of stability demanded sacrifices that weakened domestic foundations. Each restoration effort preserved form while conceding substance. Britain remained a financial hub, but increasingly as a service centre rather than a controlling node. Decision-making migrated to market. Time, 0.3s, creditors, and external actors whose priorities diverged from national strategy. This blueprint repeated across phases. During the post-war transition, Britain relinquished a reserve currency status formally, but retained financial infrastructure. The system adapted by redefining success. Influence became measured by transaction volume, rather than command. Flexibility replaced authority. This was not presented as decline, but as modernization. Yet the underlying pattern matched its predecessors. When financial systems grow larger than the states that host them, control becomes conditional. History does not portray Britain as an exception. It presents Britain as the most refined example. Earlier empires revealed the risk. Britain demonstrated the full sequence. Financial leadership creates leverage. Leverage creates dependence. Dependence erodes autonomy. The blueprint is not one of collapse, but of transformation, where control is the first casualty. The stage-by-stage pattern of Britain's loss of financial control followed a recognizable sequence, unfolding gradually rather than dramatically. Each stage appeared manageable in isolation. Together, they formed a closed loop that constrained future choices. The first stage was expansion through intermediation. Britain positioned itself as the indispensable connector of global trade and finance. Credit, insurance, settlement, and legal enforcement flowed through London. This multiplied influence without direct governance. Power appeared scalable and low cost. However, influence built on intermediation required constant participation by external actors. Control depended on confidence rather than command. The system's reach expanded faster than its capacity to absorb shocks. The second stage was balance sheet substitution. Financial returns increasingly substituted for productive investment. Capital favored overseas lending, sovereign bonds, and financial services over domestic industrial renewal. This choice appeared rational because it delivered liquidity and global relevance. Over time, it altered the internal structure of the economy. Industrial resilience declined. Fiscal capacity became more sensitive to market sentiment. The empire grew richer on paper, while becoming thinner in substance. The third stage was rigidity, disguised as stability. Fixed commitments, long-term contracts, and reputational obligations reduced flexibility. Maintaining the pound's credibility required policy discipline that limited domestic response. Options. When conditions changed, adjustment costs were deferred rather than absorbed. Stability became a constraint. Every effort to preserve financial leadership narrowed the range of viable actions. The fourth stage was shock absorption through sacrifice. External disruptions, including wars and trade dislocations, forced Britain to defend the system rather than adapt it. Reserves were depleted. Debt expanded. Policy was directed toward reassuring creditors and markets. Domestic priorities were subordinated to external expectations. Each intervention preserved continuity while transferring stress inward. The fifth stage was authority dilution. As global finance diversified, alternative centres emerged. Britain remained central, but no longer decisive. Transactions flowed through London, yet pricing power and strategic direction increasingly reflected external conditions. The system continued to function, but outcomes were shaped elsewhere. Control shifted from rule setting to rule following. The sixth stage was normalization of dependence. Reduced autonomy was reframed as integration. Loss of reserve currency status was presented as transition rather than concession. Financial openness became a necessity rather than a choice. Policy aimed to remain attractive rather than authoritative. This redefinition stabilized relevance, but confirmed dependence. The final stage was path dependency. Each prior adjustment constrained future options. Reversing course became increasingly costly. The system could not be downsized without triggering instability. It could not be recentralized without external coordination. The only viable path was continuation under reduced control. Leadership persisted as reputation, not command. This sequence did not culminate in collapse. It culminated in limitation. Britain retained a global financial role, but the nature of that role, change. Time, 0.5s. The empire of finance survived by surrendering the very control that once defined it. What emerged was endurance without dominance, continuity without authority. The pattern completed itself not with failure, but with acceptance. The alignment between Britain's historical pattern and modern financial systems is not coincidental. It reflects structural continuity rather than imitation. The mechanisms Britain pioneered were not abandoned when control diminished. They were absorbed, scaled, and redistributed across a broader global framework. What changed was not the logic of finance, but the location of authority within it. Modern systems replicate Britain's reliance on openness, liquidity, and external participation. Financial centres thrive by attracting global capital rather than anchoring it domestically. This creates scale without sovereignty. Capital flows freely, but commitment remains optional. Stability is sustained by confidence rather than enforceable balance. As in Britain's case, this arrangement functions efficiently during alignment and becomes restrictive during stress. The role of currency illustrates this alignment clearly. Sterling once operated as a global reference, not because of mandate, but because of trust, network effects, and institutional depth. When those supports weakened, the system did not collapse. It migrated. Authority over pricing, reserves, and settlement dispersed. Britain's experience demonstrates that reserve status is not lost through decision, but through gradual substitution elsewhere. Control fades as alternatives accumulate. Institutional behavior follows the same pattern. Policymakers operate within increasingly narrow corridors shaped by market expectations. Flexibility is constrained by reputational risk. Decisions aim to preserve participation rather than impose direction. This mirrors Britain's late-stage posture. Time, 0.3s, where maintaining attractiveness became more important than asserting control. Integration replaced command as the organizing principle. The critical insight is that modern systems inherit both the strengths and the vulnerabilities of their predecessor. Financial leadership built on intermediation scales rapidly, but resists recalibration. Once embedded globally, adjustment costs rise, autonomy declines before influence disappears. Britain's trajectory offers a reference not for prediction, but for recognition. It reveals how systems behave when size exceeds governance. This alignment does not imply imminent failure. It indicates constraint. Britain did not fall when its model spread. It adapted by accepting reduced authority in exchange for continued relevance. Modern systems face the same trade-off. The pattern suggests that endurance is achievable, but only through concession. Control is not reclaimed by growth. It is surrendered gradually as complexity compounds. Understanding this alignment reframes Britain's experience. It was not an anomaly of the past. It was an early manifestation of a structural dynamic that continues to shape global finance. The system persists. The question is not whether it functions, but who governs its outcomes. Acceleration occurred when Britain's already constrained system encountered conditions that demanded speed rather than stability. The architecture had been optimized for continuity, not adaptation. When pressures intensified, adjustment mechanisms lagged. This gap between requirement and capacity defined the trigger zone. The primary accelerator was scale. Global financial integration magnified disturbances faster than policy could respond. Capital mobility shortened reaction windows. Decisions that once unfolded over years now materialized within weeks. Britain's institutional framework, shaped by precedent and reputational caution, struggled to operate at this tempo. Every response was filtered through the need to reassure external participants. This delayed decisive action and amplified vulnerability. A second trigger emerged from cumulative debt exposure. Obligations accumulated across public finance, external commitments, and currency defense. Each layer reduced tolerance for volatility. Policy tools remained available, but their use carried escalating costs. Interest rate adjustments risked capital flight. Fiscal expansion threatened credibility. Flexibility existed in theory, but not in practice. The system entered a zone where movement itself generated instability. Geopolitical shifts intensified this condition. Britain's ability to enforce alignment declined as alternative financial centres and reserve assets matured. External actors gained options. Participation became conditional rather than assumed. In this environment, confidence functioned as a fragile equilibrium. Small disruptions carried outsized impact because exit pathways were readily available. Control depended on maintaining sentiment rather than shaping outcomes. The trigger zone did not announce itself through collapse. It manifested through repeated accommodation. Each episode required concessions that preserved short-term order while narrowing long-term autonomy. Emergency measures became routine. Temporary solutions hardened into permanent constraints. The system accelerated toward dependence, not through panic, but through repetition. What defines this zone is not crisis, but irreversibility. Once entered, restoring prior levels of control requires coordination beyond national reach. Britain's experience illustrates that acceleration is not caused by a single shock. It results from accumulated commitments meeting compressed timeframes. When complexity exceeds governance speed, systems do not break immediately. They adapt downward. This is the final stage before outcomes become externally determined. The system continues to function, but its direction is shaped elsewhere. Acceleration completes the transition from authority to accommodation. What remains is stability, maintained through limitation rather than command. The consequences of Britain's financial transition were unevenly distributed, but structurally consistent. The costs of maintaining global relevance were absorbed domestically, while the benefits of system participation became increasingly diffuse. Exposure shifted inward as control moved outward. Fiscal pressure intensified as policy choices prioritized credibility over flexibility. Public finances absorbed the burden of defending stability through debt servicing and market reassurance. Industrial adjustment lagged, constrained by capital allocation patterns shaped elsewhere. Employment volatility and regional imbalance reflected a system optimized for circulation rather than production. Households experienced the effects indirectly. Asset prices remained supported, but income growth decoupled from financial expansion. Stability favored balance sheets over wages. Risk was socialized through austerity and adjustment, while returns remained concentrated within financial channels. The system did not fail those it governed abruptly. It constrained them gradually. Institutions also faced exposure. Decision-makers retained responsibility. Without full authority, accountability remained national, while outcomes were increasingly global. This asymmetry limited democratic leverage over economic direction. Control had not vanished. It had been redistributed beyond direct reach. The result was endurance under constraint. Britain continued to function as a financial centre, but the price of participation was reduced autonomy. Exposure became the condition of stability. Britain's experience demonstrates that financial empires do not lose control through misjudgment or decline in capability. They lose it through sequence. Expansion precedes dependence. Dependence narrows choice. Time, 0.5s. Stability becomes conditional. What matters is not the moment authority fades, but the order in which constraints accumulate. Britain remained influential long after control diminished because systems can function without sovereignty. Endurance is possible without command. This is the central pattern. Timing is unpredictable. Sequence is not. Empires that build power through finance eventually confront the same limit. Control is not lost suddenly. It is surrendered step by step, until adaptation replaces authority as the defining condition of survival.